Yes, with that, we hope to move into a discussion on a recent development that took place in the Colombo Stock Exchange. And the discussion is based on the new fee structure that was introduced by the Securities Exchange Commission for all share transactions in Colombo Stock Exchange. And we have with us Travis Gomez from Frontier Research joining us. Welcome on board, Travis.
Good evening.
Yes, first of all, can you tell us what's exactly in this policy? What are the key features?
Okay, so this is something that was very recently brought by the CSC, and basically it's to do with the transaction fees. So quite simply what this does is, so previously basically they basically have a transaction fee based on the market value of the transaction. So previously based on a 50 million transaction, if it was less than 50 million you were charged 1.12%, and above that it was basically about 0.64% at least. So under the old regime, what happened was basically you were charged a flat fee. So for example, if you had a transaction which was over 50 million, it was say 80 million, you'd get slapped with that full. Basically, the rate is the higher rate, the rate on the top end. So that is 0.64%. Okay, and if it was below, basically you get hit with the other rate. So because of that, when it comes to transactions that happen at the margin, there's basically a big distortion that takes place, or there's a big jump when it comes to your cost. So to kind of correct that, what the CSC did was recently they introduced a new system where they basically moved from this flat fee based structure to what they call a step up fee based structure. So that is where basically, say for example, your transaction is 80 million again. Now for that first 50 million you get the 1.12% rate, and then for the balance 30 million you get the other rate, the 0.64 rate. So that through that basically the idea is to sort of reduce that distortion, and based on our computations what we found is that yes, that indeed that is kind of achieved through this measure.
Okay, with the increased transaction amounts, what are the views on the CSC with this move?
So with regard to this, so as I explained, the reason they introduced this was to basically reduce the distortion, and it seems to be they've kind of achieved that with that. But in terms of the broader industry also, they kind of view this as a positive because even though there is going to be from our computations, what it seems is that there will be an increase in the cost overall, but in terms of what we see is that the larger the transaction, the smaller will be that cost component. So overall, we don't think there's going to be a big impact, and the industry also feels this is kind of a positive move because it kind of reduces that distortions.
If you look at it from an investor's perspective, what is the view from an investor's perspective with this directive?
So in terms of, a general investor, what you really, when it comes to like investing in stocks in the equity market, what really matters to you is basically, do you have the confidence to put your money in the market? Am I sure that the policy is kind of secure?
Definitely.
So if you take these policies, a lot of the new policies they have introduced. So this plus another policy that they introduced along with this was to basically sort of to strengthen the broking industry, where they introduced this basically that brokers have to hold this minimum shareholder fund requirement. So all of these policies are kind of in line with more developed markets have also introduced, and the purpose is to kind of to make the industry more stable, to improve, to have greater confidence in the market. So if these policies are properly implemented, the shareholder should, rationally view it as something positive, give you more confidence to, put your money in the market.
All right. Such directives are given with the hope of stabilizing the market. So what would be the impact on foreign investment component?
So again, typically what the foreigners really are looking for is, they might be looking for more of a, so compared to more local investors, their investment horizons are going to be much longer term. So because of that, they are looking at a much more broader sense of risk. What is the political risk? What is the, these regulatory risk? So when they see moves like this taking place, where the regulators seem to be taking corrective action, they seem to be moving in the right direction, that again sends sort of like a positive signal to the investors. So the policy itself is a good thing, but when it comes to a foreigner deciding, okay, should I invest in Sri Lanka or somewhere else, there are like broader implications as well. So this is just one component.
All right, this directive is going to be effective in a couple of weeks. if I'm not
Yes,
mistaken.
so I mean the transaction fee will it will basically come into effect in March, 15th of March 2017.
Yes. So how has the market reacted with this direction as at present?
So right now in the short term, we haven't seen much of a movement, and we don't think that. I think the market also perceives that this will not be a big impact as it is. I think. Yeah, because in terms of if you take the actual cost, even though overall there's going to be an increase in cost, I think it's not that significant. So overall, at least in the short to medium term, we don't see there'll be a big impact in terms of the ASPI performance as a result of this.
Okay, all right. Travis, thank you very much for joining us.